When a young Atul Kumar Shah joined his father at his shop in Nakuru, he knew at once that that is what he wanted to do for the rest of his life. He would, however, witness his old man get into desperation when his retail and wholesale shop closed due to bankruptcy. The old man had run out of stock due to selling his wares on credit. But the 5 years that young Atul worked with his father were enough to teach him two vital lessons. One, cash is king and whoever controls the cash controls the kingdom. And two, there is no ceiling to progress. The more, the better. Together with his brothers, in 1978, Atul Kumar started a retail shop in Nakuru. It was slow progress for the Shah brothers, but their persistence paid off. After 10 years, in 1987, they formed the Nakuru Mattress Supermarket that metamorphosized into the now famous Nakumatt. At only 26, Atul Kumar Magnal Shah, or as he was fondly referred by his family and peers, Atul Shah, was already dreaming of greatness. To demonstrate his inward ambition to his brothers, he told them that what they had birthed was a baby elephant. Now it was up to them to feed and tend after it until it matured into a majestic beast, big enough to accommodate millions of customers and strong enough to trump any competition. The elephant became synonymous with the Nakumatt brand. It was strategically placed in all shopping halls. For the next 30 years, Nakumatt became the standard of shopping in Kenya, providing a premium shopping experience to its customers in the many malls that it operated. Over 10,000 people were employed by the giant store. Nakumatt even managed to set foot and grow in Uganda and Tanzania. But in 2017, Nakumatt died. And as of now, Nakumatt is a distant memory, and only the financial crimes in its wake keeps those memories alive. They say that the expected life of an elephant is 70 plus years, but Atul Shah's elephant died at 30. It means, therefore, that that was a premature death. So what caused the demise of Nakumatt? Was it a man-made disaster? Or was it a case of the elephant in the room being too big to contain? If you are new here, welcome. We discuss business and the financial crimes that are perpetrated in boardrooms. Kindly subscribe to this channel, leave a like and a comment, but more importantly, sit back and enjoy this mini documentary. Nakumatt and Kingsway. Traditionally, in India, the Shah surname originates from the Shah caste, a people known predominantly for trade, leadership, and royalty. Even after migrating to Kenya, the Shahs continued with their trade dominance. In 1947, two Shah families immigrated to Kenya, Ramnikal P. Shah and Magnal Shah. Magnal Shah started his retail business in Nakuru, and it was his sons who would thereon grow the Nakumatt Empire as the Shah brothers, Atul Kumar M. Shah and Nalshi M. Shah. Ramniklal P. Shah started a small tire shop along Kingsway Street in Nairobi, today University Way. His sons would thereon grow the Kingsway Empire as the Shah brothers, Atur, Manish, Sanjay and Monaj P. Shah. The two sets of brothers had successful businesses in the early 90s. They were conducting business on the straight and narrow path, correct accounting, paying the right taxes, and reinvesting in their businesses. However, for both families, that path was too slow for their ambitions. It is then that fate brought them together. They discussed their businesses and agreed to work together so as to fast-track their success story. Among the things they discussed were how to hide their real records, including cash turnovers from the roving eyes of the taxman, and how to hide their ownership in a complicated layering of companies. So sharp were the Shahs that they were able to come up with a single solution to both problems. They agreed to co-own a bank, which they would in turn operate like their personal kiosk. In 1996, they bought a financial institution named Middle East Kenya Finance Limited. They later renamed it to Charterhouse Bank. The Ramnikal Shah brothers registered their shell companies in Liechtenstein, a tax haven known for its secrecy and leniency in money laundering. The shell companies in turn owned Kingsway Investment, which owned 44% of Charterhouse Bank. The Magnal Shah brothers opened their shell companies in British Virgin Islands, another tax haven. The shell companies owned Nakumatt Holdings, which in turn owned 56% of Charterhouse Bank. Now that the Shahs had the hook, line and sinker, it was time to catch some big fish in the big money leagues. For the next 6 years, 1998 to 2004, Atul Shah led Nakumatt to unprecedented heights in Kenya. There were branches opening all over. Every new mall that was constructed had Nakumatt as its anchor tenant. Malls like the Junction, Westgate, and Highridge were known because of the giant supermarket. Charterhouse Bank was also growing. For convenience, the bank was housed within the Nakumatt supermarkets. Out of 10 bank branches, 8 were inside the Nakumatt supermarket. Peculiarly though, for the 6 years, Nakumatt's audited financial statements never reported a profit. It was making losses year in, year out. The reported sales volume and cash turnover were low, so low that Nakumatt was paying a tenth of what other supermarket chains were paying for VAT and income taxes. Nakumatt was engaging in tax evasion and money laundering using Charterhouse Bank. The bank had hundreds of fake accounts that had no faces. Once Nakumatt made sales and collected cash from its branches, the proceeds would be banked into these fake accounts. These fake accounts would never make it to Nakumatt's financial statements, making it possible to declare low sales and low cash turnover by banking a small amount in the audited bank accounts. Then, using local and international banks, the money would be cleaned and found its way back to the Shah brothers to use as they pleased without having to pay a dime in taxes. An investigation by PricewaterhouseCoopers, an audit firm, revealed, amongst other things, unregistered accounts being used by Nakumatt, large amount transfers, and clear instructions on transactions and irregularities in the accounts to and from where payments were made. An example, during the period between May 2003 and October 2003, an amount of 3.6 million shillings was transferred to an account on a weekly basis. There were 22 such transfers totaling 79.2 million, for which no supporting documentation was available, as this was said to have been destroyed in a fire. A report made by the then CBK Governor, Dr. Andrew Mullay, to the then Finance Minister, Amos Kimunya, stated Nakumatt underdeclared sales to report trading losses for over 6 years. Curiously, in spite of the losses, the supermarket chain expanded, opening numerous new stores countrywide. Nakumatt Supermarket was performing 20 times better than Uchumi Supermarket, yet paid less taxes than Uchumi. It is estimated that Nakumatt cheated KRA over 60 billion shillings in taxes over the 6 years. But the governor's efforts to investigate Charterhouse Bank were thwarted by its political godfathers. The governor was suspended thereafter. Apart from helping local businesses evade tax, Charterhouse Bank also provided global crooks with accounts for hire in order to launder their cash. The known cash traffickers included 1. W.E. Tiley, a fish processing company that operated hundreds of accounts for hire on behalf of politicians and businesses evading tax. 2. Crucial Properties, a small company operating a small hotel that laundered money from Kenya to tax havens. In 2001, for example, the small hotel received in one transaction $20 million. Paolo Saturnino, an Italian account holder whose accounts were used for international money laundering. And 4. Karaoke Muigwa and co-advocates, a lawyer's client account that was used to transfer large amounts of money without documentation. One of the minority shareholders of Nakumatt Holdings was a company known Hotnet Limited, owned by one Haron Mwao. Interestingly, the US had named the Kenyan politician, together with businesswoman Naima Mohammed and 5 others from Mexico, Afghanistan, Kyrgyzstan, as significant foreign narcotic traffickers. But this said politician was using Charterhouse and Nakumatt to launder his cash. The end of Charterhouse Bank and the beginning of the end of Nakumatt. It was in 2003 that Charterhouse Bank hired an internal auditor, one Peter Odhiambo. After a year of working there, Peter's conscience was conflicted by the malpractice that he witnessed. He wondered how the bank had operated for so long without the central bank having ever noticed anything. He feared asking questions as the management seemed to operate without care and served big politicians. He examined the suspicious accounts and found many personal savings accounts with annual turnovers in excess of 2 billion shillings. The transactions records showed funds were being diverted from Nakumatt supermarket and its related firms into various personal savings accounts, presumably to avoid taxes by underdeclaring revenues to the Kenya Revenue Authority. Odhiambo noticed a deposit of 10 million shillings a day into Nakumatt's account, and he suspected the funds were smuggling proceeds from politicians and drug lords who had hired accounts to Charterhouse Bank. He subsequently made copies of activity reports for more than 800 suspicious customer accounts and forwarded them to KRA. By forwarding them to KRA, he was hoping to achieve 2 things. 1. Expose the crime and have the perpetrators brought to book. And 2. Get a reward from KRA for whistleblowing on a tax evasion case. In total, Peter was to be paid close to 2 billion shillings for exposing Charterhouse Bank. But KRA did not act on the information, and he subsequently forwarded the same to the Kenya Anti-Corruption Commission and the Central Bank of Kenya. Peter had to flee Kenya for the USA, and he is still awaiting justice to be served. And in September 2004, Charterhouse Bank archives caught a mysterious fire. Most of the records were burnt, making subsequent investigations hard to conduct. After the bank went into administration, Nakumatt's web of deceit went with it. It was the start of the decline for Atul Shah and the Nakumatt stores. The foundation upon which the elephant was standing was starting to be exposed. Atul had made the world to believe that the foundation was concrete, but as time unfolded, the mighty elephant found itself high on a straw foundation. It was crumbling. As part of the money laundering scheme, Nakumatt had accumulated loans worth 34 billion shillings from various financial institutions. This money was taken by Atul Shah on behalf of his money laundering clients, who would then deposit the illicit money into Charterhouse Bank, and then Nakumatt would repay its lenders as if repaying a normal loan. After the collapse of Charterhouse, Nakumatt was unable to access these funds, and its normal transactions wouldn't meet all these obligations. It was found out that the recoverable amount from tangible Nakumatt assets would only be 3 billion shillings. A lot of innocent lenders lost their money. Most landlords in the malls had to write off billions in rent arrears. Suppliers of stock were left to burn their fingers. In the end, it is the people of Kenya that lost. Suppliers were owed over 20 billion shillings, and workers were owed almost 1 billion shillings in unpaid salary. all because of the greed of a few. Until the next episode, I'm Jeff Kafka.